Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And I just want to send a huge thank you to all my listeners. It dawned on me, and we did the research, that in the top 50, well, they classify them or categorize them as business podcasts and in the business category. And the subcategory is investing, of course. But in the business category, Investopoly, thankfully, is almost always in the top 50, and it is the highest rated Australian finance podcast in the top 50 with a rating of 4.9. There is one other 4.9 podcast that is quite niche, investment still towards doctors, that has a really high rating. And that podcast is Dev Raga Personal Finance. That's what it's called. 4.9 out of 5 is his rating and has about 480 odd ratings there, which is pretty extraordinary. I haven't listened to it yet, but they're the Investopoly and that podcast are the two highest rating Australian finance podcasts, which is a tremendous achievement that I'm very proud of, but I couldn't do it obviously without listeners. And so, if no one listened and no one rated, of course, it's not going to be a success. And so it's very much thanks to my regular listeners and even the irregular ones, of course, that tune in every week and support me by listening to the content. And of course, if you can share it, that's great. Well, whether that increases my ratings or whatever, neither here nor there, but I guess the whole point of producing this content, and I do put a lot of effort into each week's episode, the more people that can benefit from it, either directly or indirectly, the better off I think we'll all be. So thank you so much to all my regular listeners. All right, well, let's get into today's episode. And today's episode's about how property decisions have a significant impact on our financial position and our financial plan. So, what we decide to do with our property decisions or how we make those property decisions could have, and probably mostly will have, far-reaching impacts on other decisions like debt management, how much we contribute to super, how we're going to fund retirement, all those sorts of things. And so in today's episode, I wanted to share some stories about situations and advice situations that we've been involved in that sort of demonstrate this point, because I think that's probably the best way to kind of demonstrate how interrelated it is. And I guess the surprising thing from my perspective is, CoreLogic just reported the total value of Australian property is around $11 trillion. Now you compare that to the Australian stock market, so all the companies listed on the Australian stock market, that's about $2 trillion. So property's 5 times larger as an asset class. And despite this, traditionally, most financial advisors have, very little experience and knowledge with respect to, property attributes and how property can fit into a strategy and the taxation considerations and the loan structuring considerations, all the stuff that goes along with it. They don't have necessarily, well, I'd say the vast majority don't have that. And in my experience, from planners that we've worked with, hired and worked with, property tends to be, at best, an afterthought, a client-led thing. So, that is, the advisor won't bring it up, but the client might say, I want to go and buy an investment property. And the advisor tends to not have too much other than sort of cash flow analysis and, setting sort of a budget. Beyond that, there's not a lot of value they can add just because they don't have that experience. And I think that's a big problem, because it's my thesis. I believe that there's really a handful of property decisions that people make in their lifetime. Whether it's buying a home, buying your first home, your first property, upgrading, when to upgrade, when to invest in property. There's not a lot of decisions we make in life typically with respect to property. Maybe there's 5 or fewer over our lifetime. And how well we make those decisions can have, as I said, far-reaching consequences. We can drastically improve our financial position, or if we don't make great decisions, we can hamper our financial position and really, at worst, lose money even. So what I want to do is share some stories about, just to sort of demonstrate this point and give you some real life specific examples of, how that integrates. And my belief is that, the financial advisor industry needs to get on board. They need to be asset class agnostic, which means that you come to a financial advisor, they have equal experience and knowledge in both property and shares. And then they can weigh up the two in terms of which one should you invest in next and what proportion should you hold in the share market, which, obviously your super's in there, and the property market. So there's a couple of reasons, before I get into the sort of examples, there's a couple of reasons why financial advisors historically have steered away from property. So firstly, about 10 years ago, 11 years ago, financial advisors primarily relied on commissions from investment products as their main source of income. That's how they were remunerated. And so if you go and see a financial advisor, let's say 15 years ago, and sit in front of them and say, should I put my money into managed funds or should I go and buy an investment property? Well, in one of those circumstances, the financial advisor is going to be paid. The other circumstance, they're not. So you can guess what the answer was. Now, commissions were banned, and even the grandfathered commissions were banned about 5 or 6 years ago. So we've removed that significant conflict of interest, and now financial advisors are not allowed to receive conflicted remuneration, such as investment commissions, which is, I've said this before in this podcast, the best decision any government has made in Australia, I think, with respect to the financial services industry, certainly in my lifetime. So now when you go and see a financial advisor, all you need to decide as the client is, look, can I work with this person? Do our personalities gel? Because obviously you've got to have a close working relationship for a long period of time. And then secondly, do they know what they're talking about? And so just like when we go and speak to an accountant or lawyer, it's the same sort of thing. You don't need to then worry about all the conflicts of interest that used to occur. The other problem that used to happen as well is that some advisors started to build relationships with property developers. And so what would happen is the property developer would go, look, I'm building these townhouses or houses in a new development area or an apartment block, whatever it might be. If you sell these or recommend these as property investments to your clients, I'll pay you a commission. And those commissions were, $20,000, $30,000, $40,000 per sale. And so some financial advisors started doing that as say, well, we recommend property. Look at us, aren't we great? But really then they're getting a massive kickback. Who's paying for the kickback, the end purchaser. Obviously, it's included in their purchase price. The developer makes their profit. And quite often, the poor client is left with a property that isn't worth what they've paid. And so what a lot of dealer groups did, and so a dealer group is, a group that has the financial services license that then allows other advisors to use that license. What the dealer groups did is banned or prohibited advisors from talking about property to, make sure those sorts of arrangements didn't happen. And so they're the sort of two things that have occurred over the last 20, 30 years that have resulted in essentially a lot of advisors now today don't have or haven't had a lot of exposure to property and how it fits within a strategy. So now typically then people seek advice from then two parties. Like if they want to make property decisions, they might go and speak to a buyer's agent, and some of these buyer's agents firms prepare sort of property strategy plans and these sorts of things. And then for all the other matters, they'll go and speak to a traditional financial planner. Now, the problem with taking this approach is the division isn't ideal because buyer's agents don't necessarily have the comprehensive sort of financial planning expertise to fully understand the broader implications of property decisions. So, for example, if I'm going to invest to this level, what impact does that have on my ability to make super contributions or execute on my other goals and so forth? So it's not an ideal situation. What the ideal situation is that as the industry attracts new financial planners, new advisors, it's my experience that the younger generation, rather than the older generation that's been in financial planning for a long time, and no criticism on those guys, of course, but the younger generation seems to be more inclined to want to do work that they're proud of. And that means, coming in with a fresh set of eyes and saying, okay, we don't have that history of commissions and selling managed funds and so forth. We want to learn about all asset classes, and we want to give that, asset class agnostic, comprehensive, holistic financial advice. So as we attract new financial advisors to the industry, that's what needs to happen. The sad thing is that the financial planning industry, because of barriers to entry and over-regulation, we aren't attracting very many new advisors to the industry. So it's a big problem, I think, for Australia. And I'll get off my soapbox now, but I just wanted to give you that sort of context, if you like, for, what's got us here. Okay, so let's get into some of these sort of case studies. I don't know if you call them case studies, but examples that I want to share with you, real life examples, how we've worked with clients that I think give you a clear indication of how integrated property decisions are. Okay, so let's start with the first one. This client owned 2 investment properties, and we looked at them and we did our analysis and assessment, looking at returns, the attributes of those properties, locations, all those sorts of things, including performance of comparable properties in those locations relative to what we would regard as investment grade assets. And we concluded that both of them weren't that great. One was slightly better than the other, mainly because of the time the purchase was made. These properties were purchased when they were newly constructed, and so the construction costs were so much lower. I think 20 years ago, the first one was purchased, and so that's why the investment returns have performed better. But the client wanted to buy a holiday home. That was their sort of goal in their strategy. We need to build a strategy around obviously achieving that goal. And the client had other assets, shares, cash, super, of course. So there was a few assets that we could play with in order to achieve that goal, but also these 2 sort of average quality investment properties. So after doing a lot of analysis, particularly looking at capital gains tax as well and trying to sort of minimize that, we decided to sell the worst quality asset, the one that we thought won't have the characteristics to drive future performance over the next couple of decades. So we're going to sell that asset. But we decided, let's not sell it yet. Let's wait until you buy the holiday home. Firstly, it could take a little bit of time to find it. Who knows what the market will do between now and then. We weren't that concerned about the price dropping necessarily, but may as well stay in the market. Prices tend to trend higher over time anyway, albeit at a slower rate for these assets, but you may as well just pick up some capital growth if it's there. But most importantly, let's delay paying the capital gains tax. No need to sort of do that. So actually just recently, the client purchased a holiday home and he ended up selling the investment property to the existing tenant, which was kind of good because it was really easy and clean and so forth, and something we always talk to our clients about. If they're going to go sell an investment property and they do have a tenant in the property, let's engage with the tenant. Quite often the tenant's not in a position to buy, that's why they're renting typically, but it's worth asking the question. So in order to develop this strategy, of course, there was, a multi sort of faceted approach. There was lots of factors to consider, of course, the tax implications, the asset class options. We could have sold down some of the shares. We could have even borrowed some money if we wanted to, although we were keen not to do that as the client wants to enter into retirement in the next couple of years. And then working out which property, if we're going to sell property, which ones should we sell, having regard to, future possible returns and the attributes of the assets as well. And it's important, I think, to highlight that I've heard many stories from clients telling me that previous financial advisors have advised them to sell an investment property. And if the client followed that advice, they would have been worse off. The property was otherwise great, but of course the advisor wanted them to invest the money into shares or manage funds or those sorts of things. And these things might have happened in the past and they could still happen today because, of course, if you go to an advisor and they don't know anything about property, the only way that they can work with you is if you have a substantial share or managed fund portfolio, then they can manage that and then they can justify their service. So there is sometimes a conflict of interest when you go to an advisor that can only provide you with that share and managed fund advice because that's the only service they've got to sell. Anyway, I've heard lots of these stories and, you just want to be really, really careful when following a recommendation to divest of a property. And I know it sounds a bit strange because I've just given you an example where we've in fact given that recommendation, but it's important that it's done. The analysis is completed very thoroughly. And we don't make that decision lightly. In fact, we always sort of lean towards holding rather than selling. And that's just because prices tend to trend higher over time anyway. And then you've got transactional costs, you've got taxation costs. And you don't want to be in a situation where you wake up in 10 years' time, you read in the paper that property is resold for double the value that you sold it for 10 years ago. You only kick yourself if that happens, right? So I want to be really careful about making recommendations to divest of property. Some properties are no-brainer if it's a complete dud, of course. But, that's a really good example of how working out which property to sell and when to sell it to minimize capital gains tax was critical in this situation with this client. Okay, my next story is about a client and a strategy we just finished. In fact, Jim and I personally worked on this strategy, and the client approached us to develop a holistic wealth strategy for him as he was nearing retirement. The client had several $1 million of investment debt, although it was backed by a lot of assets. The overall loan to value ratio was about 35% or something. So whilst he had a lot of debt, he did have a lot of assets. The problem, however, was that all the assets he had was property, so they're all liquid assets, and he had just finished 2 5-year interest-only periods. So he's with a particular bank, he had 1 5-year period, they rolled it over for another 5-year period, and it was just coming up to maturity. And the bank refused to give him another 5-year interest-only period just because borrowing capacities contracted over that time as well. And of course, the client's approaching retirement in his 60s, early 60s, I should say. And as a consequence, the repayments on the loan were going to switch over to principal interest over the remaining loan term of only 20 years. And the consequence of that is it was several hundreds of thousands of dollars in terms of repayment commitment. Of course, the client couldn't and didn't want to make those repayments. So we did analysis of all the property holdings he had, any other sort of minor assets, and decided, okay, we're going to sell 2 of his 7 investment properties. We're going to sell one now and sell another one over the next couple of years, just giving us a little bit of flexibility to be able to accommodate sort of market conditions and try and pick the right time and so forth, and be a little bit strategic. We also then were able to refinance about 60% of his debt back onto interest only, and that gave us a little bit more time to sell that second property. So it means, we can afford to, wait 2 or 3 years before we sell that property, again, to try and minimize capital gains tax, as well as trying to give ourselves some flexibility being strategic to sell that asset. And then also we were able to, it was just a perfect time, a confluence of events really, where we were able to start a pension in his self-managed super fund, because the first property we're going to sell was in that super fund. And so by quickly starting a pension before he takes up another contract for employment, we can substantially minimize the capital gains tax. So when I look back at this plan, it was quite detailed, probably one of the more challenging ones that we've worked on over the period of time. Would have been impossible to do if you didn't have, good deep knowledge of property, to work out and understand the nuances between the different types of assets, the characteristics, and how they might perform over the future. But also then there was some challenging mortgage broking there, to try and get as much of the assets, the debt, onto interest only. Then he had some interesting ownership structures, which created a challenge. Loan sizes created challenges as well. Tax planning, as I've talked about, and then obviously the traditional financial advice as well. What are we going to then do with the money inside super now that we're going to sell that property? Well, one of the benefits is we have more liquidity now, which allows us to be able to service any debt outside of super and therefore give us a greater runway to make those property divestment decisions. And so whilst we're, of course, grateful that the client sought our advice when he did, I can't help but think that he probably would have been in a better situation if he came to us, 5 or 10 years ago, because, being a little bit more strategic around, how do you take a large property portfolio and then transition into retirement? To my mind, you probably want to start, or at least consider starting, that transition 10 years before you contemplating or want to have the flexibility to stop working, to give yourself enough of a runway to make sure we're going to manage the loan situation effectively. You want to stagger interest-only maturity dates, for instance, to sort of spread that risk over and be a bit more strategic to understand if we're going to sell some assets, which ones and when, and all those sorts of things. Anyway, it was great that he reached out and engaged us, and it's been a fun one to work on, but I thought it was a good example of how it all comes together. Okay, the next story isn't one that I worked on. In fact, our senior financial advisor, Campbell Wallace, worked on it. And he recently assisted a client in evaluating whether to renovate his existing home or upgrade to one that better suits his needs, but in the same area. And that area was a blue chip suburb in Brisbane. So it was a great location. It was really just about whether the home suited their family needs. And as I understand it, that means more accommodation or more bedrooms and living area and a pool in the backyard, which, is a waste to have in Melbourne, of course, because we don't have great weather, but a necessity in Brisbane. So since the quality of the underlying land was similar in both scenarios, the differences really to focus on was just the potentially slightly larger block of land, and then, of course, the larger accommodation size. And in our view, the advantages of upgrading, so selling and then buying something that suits their needs, just didn't justify the transactional costs associated with that buying and selling. And therefore, what we recommended is the client just improve his existing home. Now, of course, these are important decisions, right, that could end up costing you a lot of money. You could end up, in those scenarios, what I've seen is sometimes people will go and sell their home, which is otherwise a great home, and then try and get more accommodation, but they don't want to compromise in locality. So then they might buy on, a sort of corner block on a busy main road or something like that, because it's a little bit cheaper and they get more for their money, but they get to stay in the same area. The problem with doing that is obviously you're selling out of a property that's very good quality to one that has some impairment just to make the strategy work. So, that's an example of how when we make these sorts of decisions, they can have, unintended consequences, negative long-term consequences that won't dawn on you maybe at least initially, but you look back in 10 years' time and go, well, that wasn't really a great decision. And that's why, this is a good example of how helping clients make smart property decisions, even if they're related to their home, does add a lot of value. And of course, like everything, or like many aspects of advice, there's lifestyle and financial goals, and they're deeply interconnected. So you got to sort of balance those two things out. But, most people just want to make the right decision, or if they're going to make a decision and it comes at a certain cost, as long as we can quantify that cost and be comfortable that, hey, there's a cost here, but we're not going to compromise our future retirement, so we're comfortable with it. And I think that's our role, is to help clients make educated decisions like that. We can't necessarily overlay the lifestyle considerations. That's for the client to work out how important it is. We just need to provide the context as a result of making that decision, so that in 10 years' time, they don't look back and regret, whatever they did. Okay, my next one's probably the most complex strategy that I have worked on in the last couple of years. So back in 2022, I developed a strategy for a client that was living and working overseas, and they were going to stay overseas for the next 6 to 7 years. And after that time, their plan was to return to Melbourne, and that was going to be their long-term home. So they've got young kids. They're going to then send them to secondary school in Melbourne and put down roots, and that's where they're going to be. And so I spent quite a lot of time thinking about and analysing this strategy for this client. And maybe the complexity isn't obvious at first glance, but certainly as you got deeper into the strategy, it was quite a bit of a head scratcher, to be honest. Anyway, I compared 3 scenarios. Buying a house in a location where they might like to live. Now, in that situation, we'd buy something mostly for land value, even if that meant we had to, renovate or bulldoze and rebuild the dwelling in the future in 6 to 7 years when they return to Melbourne. But let's get the parcel of land. Because in this scenario, one of our risks is that whatever we do, if we don't get into the property market, and whatever we do, if it underperforms the Melbourne property market, then we've got an affordability issue. We'll get priced out of the market potentially. So that's our main risk for these clients. So that was the first one, is let's go and buy that land now. Second one was don't purchase any property and just invest in shares, and invest as wisely as possible to try and build as great a deposit so that we can come back and go and buy a family home as well as fund retirement. And the third option was sort of in between, let's go and buy an investment grade sort of villa unit or house. So, there I'm trying to sort of minimize the budget as much as possible. That's just a pure investment property that they wouldn't ever occupy, of course, and hopefully they wouldn't need to sell in 6 to 7 years, from a borrowing capacity perspective, because obviously the investment property eats up some borrowing capacity. So we didn't want to go too hard there, because we don't want to buy something today and then have to sell it in 6 years' time. The transactional costs will kill us and make it not worthwhile. The other complexity with this one is for Australian non-tax residents, the taxation with property versus shares differs significantly. So for capital gains tax, there's no capital gains tax on shares while you're an Australian non-tax resident. So the second option of just investing in shares was very tax effective, because it wasn't going to give rise to any Australian tax. Whereas with property, if you're a non-Australian tax resident, you're going to pay capital gains tax on any uplift in property value, and you don't get a 50% capital gains tax discount, that you'd normally get if you own an asset for more than 12 months. So the property aspect was quite tax inefficient. And that's one of the other complexities that we had to sort of work out. But also we had to have the knowledge to work out, okay, if we're going to buy a family home, what does that look like? How can we, what budget do we need to get the attributes that we need? Which is really, a good size block of land that we could build a family home on in a good location. What is that going to cost us, and how can we buy that as effectively as possible? Versus what is the minimum we can spend in the third strategy for a pure investment property, so that we're not tying up too much equity and borrowing capacity, particularly when the clients return in 6 to 7 years' time. So it really was a challenging strategy, and one, again, if a financial advisor didn't have that property expertise, to try and bring it all together, as well as then work out, okay, when they do come back to Melbourne in 6 to 7 years, and then we do go and buy the family home, that's obviously then going to give rise to a lot of debt. Then how do we repay that home loan debt and still make sure we have enough super and other assets to fund retirement? So, there's that first step, what do we do now over the next 6, 7 years? And then the second consideration is then, if we do that, how does that then play out over the rest of our lifetime? And how do we ensure, because when we're non-residents, we're not contributing to Australian super. And so most non-residents come back to Australia with low super balances. The upshot was we decided we went the third option, buy the investment property, which we've already done, invest in the share market, build a pool of assets. And we feel like that's going to give us sort of the best of both worlds. We get into the property market now, hold that property for the next 30 or 40 years, let that compounding capital growth do its thing. And that mitigates our risk of putting too many assets into the family home in 6 to 7 years when we get back, and then not having enough investment assets in 30 years' time or 20 years' time, whatever it might be, to fund retirement. But that was a really challenging strategy that I worked on, and one that I sat back and thought, yeah, well, there's not many people that are going to be able to do that. I hope that doesn't sound arrogant, but it was a perfect example of how that comes together. Now, we don't work with non-resident clients anymore. It's too difficult with the Australian legislation and so forth, but it is a good example of that sort of situation. Okay, my next story is about another one that Campbell Wallace has worked on just recently, in fact, for a brand new client. They're living in Sydney and they're renting at the moment, and they're happy to rent for the foreseeable future. However, in my experience, certainly over the last 23 odd years of working with clients, every single time when a client's come and told me, yeah, no, we're happy with renting, no problem, no worries, at some point, they're going to come to me and say, Stuart, we want to buy a home. We're sick of renting. We want to have the confidence to be in a particular place for a long time. And, landlords, it's a landlord's decision whether they want to sell the property or whatever. So I always think when we develop a plan when a client's renting, we always need to make sure the plan is flexible enough to accommodate buying a family home in the future. But the big problem with that, or the challenge with that, I should say, is that firstly, buying a family home, say 20 years from now, it's going to cost a hell of a lot more than it costs today in today's dollars, right? Because of compounding capital growth, particularly if we're going into a really good area, that's our problem. The other problem then is we've got to pay for that purchase from after-tax dollars, which means I need to either save a lot of money in cash, which is pretty lazy, don't really want to do that over the next 20 years. Then I'm going to have to sell investments, which is going to give rise to some taxation considerations. So then it's really, okay, what are we going to invest in to maximize our returns over the next period of time, and also do it in a way that's going to be tax effective. So if we need to go and sell the big lump sum to go and buy a family home, we can do so. So what Campbell developed was a strategy just specifically around, a broader strategy, but specific around this property issue or consideration. First step was, let's go and buy an investment grade property in a location that we think that's going to meet their needs. And this is critical, right? In the previous strategy, the overseas clients, they couldn't, with high level of confidence, tell me where they'd want to be, because that strategy of go buy the family home now and just spend the next 6 to 7 years repaying debt, that would have actually been financially better off for them. I should have mentioned that. But they couldn't tell me with a high level of confidence where they'd like to be. So we don't want to do that, because that's really difficult. I've had experience with that before. It's a waste to buy a property that you actually never end up wanting to live in. With these clients, though, they were really sure about where they'd like to be. So what we're going to do is go and buy this investment grade property. It's going to be, quite a high value property. That's okay. They can afford it. We'll spend most of our money on the underlying land value. And the idea will be, if we want a family home one day, this is the location we'll be in. And even if we have to bulldoze the existing dwelling and rebuild, no big deal. So the second part of the strategy, then we're going to accumulate a pool of investment assets in a tax effective structure that allows us in 10 to 20 years, if we do want to go and bulldoze and rebuild that house, we can do so, and we can do that in a tax effective manner. So that is spreading the tax burden or having consideration of the tax burden over the entire strategy to make sure that we're minimizing it to give us that flexibility. So rent investing, which is, rent where you want to live and then invest where it's appropriate to invest or best to invest. It's a popular strategy and it's growing, but anyone that rent invests, the only thing I would say to them is just keep in the back of your mind, one day if you change your mind, how are you going to afford to buy a home and not have to compromise in terms of the size and quality of that home and the location of that home, because it could put a really big dent in your assets if you do change your mind, you want to go buy a home one day and not rent for the rest of your life. And the last one, just quickly, was one that I remember working on many years ago. But obviously schooling decisions have a big impact on where we're going to buy a home or where we want to live. One of the major things, it's not the only thing, but one of the major things. I remember doing some work for a client, and it was many years ago now, where we sort of compared, well, in the area that there weren't any good public schools. So the only option then was private school fees, which obviously an after-tax expense. Or they could actually sell that place and move to a different location, actually in a good or well-regarded public school zone. And if they did that, they were quite comfortable then to send their kids to that public school, and they would then avoid the cost of those, non-tax deductible private school fees. And so in that situation, there's a couple of benefits. Firstly, properties in sought-after public school zones tend to enjoy higher rates of capital growth. So there tends to be kind of a better asset, if you like, from an investment perspective. I know a home's not an investment, but just something we think about. And then of course, that capital growth is tax-free. And conversely, we get to avoid a large expense that has to be paid from after-tax dollars, which is private school fees. So from a wealth perspective and from a taxation perspective, it was a superior strategy and really sort of fit the client's needs. And of course, by taking that approach, it frees up a lot more cash flow where the clients can then invest in other assets, including super. So there you go. There's a lot of examples there, and today's episode is a little bit longer than usual, so I apologize for that. But I think those examples really give you a good flavor for how property decisions can profoundly impact one's, financial situations and future financial position. And this goes beyond just the simple fact of, advising our client on how to invest in property. Of course, that one's an obvious one, how, where, when, what budget, all those sorts of things. That's pretty vanilla. But there are a lot of, as I said, I reckon we make 5 or fewer property decisions over the course of our life, and the quality of those decisions can have and probably will have far-reaching and long-term consequences on our sort of financial position. If we do well, we'll maximize our wealth. So again, apologies for a long episode today. No time to get into any questions, unfortunately. Q&A. We'll get to more next week, but thanks very much for listening. And again, thanks so much for leaving, really great ratings on the podcast, it being the highest rated podcast in the top 50, something we all should be proud of because you've made a contribution as well. Okay, thanks very much. That's it for me. Until next week. Bye for now.